Welcome to the Simple Market Signals, Signals Explanation, and Application Ideas Training. The ideas presented in this presentation are just that, ideas. Nothing in this presentation represents a recommendation or advice, specific or otherwise. You are always 100% responsible for your actions and the consequences of those actions. This training video will cover ideas on how you may want to use the various signals within the Simple Market Signals model. Understanding the information in this presentation will help you get the most out of your subscription to Simple Market Signals. Your individual application of each signal is always 100% up to you and should match your personal investment knowledge, experience level, goals, risk tolerance, and time horizon. The Simple Market Signals weekly risk-based signals identify the level of risk in the U.S. stock market according to our proprietary model at the time of signal publication. These signals are published each week in our weekly newsletter, which is emailed to our subscribers each weekend. Our goal is to have that newsletter to our subscribers by Saturday at 2 p.m. Eastern Standard Time. However, depending on our production schedule, the newsletter could go out anytime over the weekend. Additionally, if there are any major signal changes in the middle of the week, we will email to our subscribers a special midweek update with those changes. Also, please note that there is no information published on our website. Our website is there to facilitate the sign up to our service, and all subscriber communication is done via email. The weekly emailed newsletter isn't fancy, it's effective. It's plain text, no color, no fluff. There are more ways to use, apply, and benefit from the signals than most people realize. One of the major objectives of this presentation is to help you understand many of the various ways to apply the signals. Remember, stay true to yourself, don't try to do it all, and pick and choose what's right for you. So if there's a strategy that I'm going to talk about it that you don't use, if you don't trade options, don't use the option strategies I recommend. If you don't use margin or other leverage, then don't employ those things. So these are just going to be ideas and ways that you can use the various signals just to help you understand how big the application could be and all of the various ways you can use the Simple Market Signals, weekly signals, to help you with your investments and your trading. Let's start off with the signals. The signals are simply green, yellow, and red. Let's drill down on the green signal. The green signal is your best risk versus potential reward signal. The green signal has the lowest market risk associated with it and the lowest market volatility associated with it. The green signal is your best long equity risk signal. So when I say long, of course, that means that you own the underlying. Okay, so if you're going to own equities, right, the green signal is going to be generally the best signal to be long equity. So it's your best signal for equity ownership. And what we normally experience in a green signal is positive market action. So most upward market progress will be made in a green signal environment. Keep in mind that most stocks follow the overall stock market direction. So getting the market right first is absolutely critical to any form of investing. Okay. So again, most stocks follow the overall stock market direction. And so even if you're an asset allocator, the green signal is going to be your best signal for your most aggressive portfolio. So if you have a 70-30 or an 80-20 portfolio, so again, 70% would be equities in this case on a 70-30, and then 30% would be bonds and other diversifiers, and or if 80-20, same thing there, right? 80% equities, 20% bonds and other diversifiers. So if you're an asset allocator and the signal is green, that's where you would want to use your most aggressive portfolio, okay? Your 70-30, 80-20, whatever it may be. Also, you can use any signal changes to tactically rebalance your portfolio. So let's say you have a 60-40 or a 70-30 portfolio. Anytime there is a signal change from one signal to another, you can use that signal change as an opportunity to tactically rebalance. So in this example, you can tactically rebalance on a signal change to green from a previous signal of yellow or red. Okay, so it gives you an opportunity. If the market's been falling and maybe the signal has been yellow or red, we know that the equity portion of the portfolio is probably down a little bit. Maybe the bonds are higher. So in this example of a 60, 40, 70, 30, where you have 40% bonds or whatever, 60% equities. So maybe your portfolio in this 60-40 example now is 55% equities and 45% bonds. Well, when it goes back to green, then you could rebalance and get it back to a 60-40. Okay, so just examples on how this can be used. But again, even if the only thing you used the signals for is to tactically rebalance your portfolio in your 401k, your 403b, your IRA, whatever it may be, this can make a huge difference to your returns and your risk profile over time. So now let's move on to some more aggressive strategies here. So when the signal is green, you can buy calls, okay? So if you trade options, you can buy calls with or without owning the underlying position. All right. So if you've been studying a stock, or you've been looking at the overall market, whether it's the S&P 500, the Dow, maybe it's Apple, Microsoft, whatever it is, or a sector, okay, and you want to have exposure to that, you can buy just a call, okay, on whatever that underlying investment is without even owning the underlying investment. Now, again, if you don't trade options, if you don't understand these strategies, guys, don't think you have to use all of these. These are just ideas, and this is why I'm putting this out, because I think I know most people don't understand how big this can be and how many ways there are to use the signals within the model, okay? But if you are an options trader, then you can buy a call with or without the underlying position. So another example would be, let's say you own 100 shares of Apple, but gosh, Apple, you think Apple's going to continue to go up. The signal is green. Again, we know that most stocks follow the overall market direction. So let's say I wish I had another 100 shares of Apple, but I can't afford it. Well, in this example, and again, just examples, right? Go out and buy one call. So you own 100 shares of Apple, you buy another call, which would be equivalent to controlling 100 shares of Apple. Again, you'll have to do research on how far out of the money, in the money, how far out you go on the expiration date. You'll have to do your own research on that, okay? But you can buy a call on Apple or whatever it may be and get more exposure, even if you own the underlying. Gives you an opportunity to maybe profit a little bit more on the upside without having to lay out the cash to buy another whole 100 shares of that stock, or the sector, or the SPY, the DIA, whatever it is, ETF that you may be using to get exposure to the S&P 500 or the Dow, or whatever it may be. Okay, so again, buying outright calls, and the green signal is also going to be your best signal for leverage on equity. So again, whether you use options, whether you use levered ETFs, I know a lot of people want to use the 2 and 3x ETFs. So like the triple levered ETFs that give you exposure to the S&P 500, whatever. If you do that, and I'm not suggesting you do it. If these aren't your strategies, guys, again, I'm not saying, hey, you have to go out and do that. These are just ways to use the various signals. But the green signal, if you're going to use leverage, if you're going to use long options to the upside, if you're going to use levered ETFs, if you're going to use margin, the green signal would be the right signal generally to employ that type of a strategy. You generally wouldn't want to do those things with a yellow or red signal, because we know that in a yellow or red signal, the market is generally going to fall. At least the early part of that signal, you're going to probably experience some downward market movement. So being long leverage or using levered ETFs that give you upside exposure, that probably would not be the right time to use those types of strategies. Okay, but be quick to delever and cut your losses if positions go against you, especially if you're using any form of leverage. Now let's talk about the green signal application for financial advisors. I have a lot of financial advisors that subscribe to Simple Market Signals. It really helps out the financial advisor. So if you're a financial advisor, you can use any of the green signal strategies listed when and if applicable, depending on your client base, what your firm allows you to do. And you can use the green signal for timely client conversations. So any of these signals, but in this case, we're focusing on the green signal. Clients calling you, asking questions, you look, you see what the signal is, and you can have a very timely client conversation around the meaning of that signal. You can also use a signal change, any signal change, but in this case, we're talking about the green signal. You can use a signal change for timely client contact and conversation. So anytime there is a signal change, it's an opportunity for you to go back through your client base or your prospect base and start to have conversations around the current market environment based on the signal change, whether it was an up or down signal change, right, from green to yellow or yellow to green or whatever it may be. And you can have a very timely contact and conversation with those clients and those prospects. Also, as a financial advisor, you will want to use the signal changes to make timely compliance-mandated adjustments or trades in client portfolios. And if you're a financial advisor, you're going to know exactly what I'm talking about. I'm talking about any SEC, compliance mandates, any firm-level mandates that you may have, and the next bullet point here kind of ties into that fourth bullet point, but simple market signals can help you meet your minimum trade requirements where applicable in a timely and tactical way. Again, if you're a financial advisor, you're going to know exactly what I'm talking about. Now let's move on to the yellow signal. The yellow signal is where we're experiencing moderate to increasing risk versus potential reward. So anytime there's a yellow signal, we're starting to see the market go sideways to perhaps slightly down. So in a yellow signal, we will be in an increasing risk environment over what we would be experiencing with a green signal. So a yellow signal has moderate to increasing market risk associated with it and moderate to increasing market volatility associated with it. And in the yellow signal, that means there is moderate to increasing risk for equity exposure. And again, equities in a yellow signal are generally sideways to down during the yellow signal. Again, as we know, most stocks follow the general direction of the overall market. So if we get the signal right, if we understand what's going on at the market level, it makes our other decisions that much better and that much easier. Now, during a yellow signal, you may want to reduce your equity exposure and increase cash or high-quality bonds. The choices are always up to you, okay? But, this is one way to use the signal. So again, in a yellow signal, you may want to reduce your equity exposure and increase cash or high-quality bonds, depending on how you want to handle your risk reduction. You may want to go to a more conservative portfolio construction. So if you're an asset allocator and maybe you had a 70-30 portfolio during the green signal, maybe you want to have a 50-50 portfolio as an example. These are just examples. You have to figure out how you're going to employ these signals. But you may want to have a 50-50 portfolio that you would use during the yellow signals, and then your 70-30 or 80-20 or whatever it is what you would use during the green signal environments. But during a yellow signal environment, you may want to have a more conservative portfolio as your default portfolio for a yellow signal. And again, that's for those of you that employ asset allocation, or maybe you have your asset allocation in your 401k, 403b, whatever it may be, and that's where you use this strategy. Also, during a yellow signal, you can use this to tactically rebalance your portfolio. So if we've been in a green signal environment for a while, we go to a yellow signal, you probably made some money during the green signal, your equities are up. We go to a yellow signal, you go in there, as soon as that yellow signal comes out, you tactically rebalance your portfolio and capture the profits made during the green signal environment. Also, in a yellow signal, you will want to dollar cost average new money into your retirement plans. Okay, so DCA just stands for dollar cost average. RP means retirement plans. So dollar cost average new retirement plan money during yellow signals. The reason for this, any of you that understand dollar cost averaging, it's kind of like accidental market timing. Okay, dollar cost averaging is going to work best in a more volatile environment. So if you do decrease your equity exposure during a yellow signal, I would encourage you not to change your dollar cost averaging to the downside, at least on your retirement plans. If anything, you may want to increase the amount that you're putting into your retirement plans, because those are generally very long. If you're in your 20s, 30s, 40s, even 50s, that money is 10, 20-year money at least, right? So dollar cost averaging into volatility actually works better than if you're dollar cost averaging into a more sedate market environment. So this is, again, one of these ideas where it seems perhaps counterintuitive, but if you understand how dollar cost averaging actually works, you can benefit from these signals by ramping up your exposure, your dollar cost averaging, or at least keeping it intact during the yellow signal. So you may want to even employ a barbell strategy. Okay, there's no bullet point on this, but it's just something. I was just actually talking to my wife about this last night because on her 403b, what we do in these types of environments, we set the larger bucket of money that she's already invested. We put that into a more conservative, maybe cash or whatever type situation, but we continue to dollar cost average into her 403b so that she's benefiting from the volatility, okay? And if you don't really understand what I'm talking about, please go out, Google some things, study dollar cost averaging, because this is extremely important for you to understand. And again, dollar cost averaging into a more volatile environment actually works better than dollar cost averaging into a more sedate environment. So the dollar cost averaging, do that during the down periods, right? Really keep that intact, but you may want to keep the bulk of your money. If you have $50, $100, $200,000, whatever it is, in your 401k, your 403b, you may want to put that into a more conservative slot during the yellow and red periods. Again, it's always up to you, right? Just sharing ideas on how this can be used. But you may want to protect the large bucket of money that's already been invested in your retirement plan so that you don't see 10, 20, 30, 40% drop in that, but at the same time keep the new money going in to your portfolio, especially into equities, things like that, and I say portfolio, I'm talking about your 401k, 403b, but you might want to continue to have the dollar cost averaging going into the retirement plan, especially the equities, because they're going to be very volatile during the yellow and perhaps red periods. Again, we'll talk a little bit more about that on the red signal, but the dollar cost averaging, again, just to drill down on this, guys, because it's super important for you to understand this. It's going to work best in the yellow and red environments, okay? So continue to dollar cost average your retirement plan money during yellow signals. And also, during a yellow signal, you can sell covered calls. Again, if you use options, these are just ways to use it, right? If we go into a yellow signal and you've got some buy and hold long equity positions, again, long just means you own the underlying, and maybe you've got shares of Microsoft, Apple, whatever it is, and you don't want to sell them. You say, oh man, I really don't want to sell this stock, okay? Well, one way to benefit, or at least somewhat protect yourself, is to sell a covered call to recoup a little bit of money on the underlying position, because we know in a yellow signal, you're probably more than likely going to experience a downdraft in a stock. Or you can do the same thing. You can sell calls on ETFs. You can sell calls on sectors. You can sell calls on individual stocks. You can sell calls on, the SPY, the SPY that gets you exposure to or whatever ETF you use to get exposure to the S&P 500. You can do the same thing on the DIA if you use the Dow. You can sell calls against these ETFs, okay? So again, I'm not saying go out and do all that. Again, if you do this stuff, fantastic. If you don't understand it, you're not comfortable with it, don't feel like you have to do that. These are just ideas, okay? But again, during a yellow signal, you may want to sell a covered call. Covered means you own the underlying, right? On your long owning equity positions, okay? So sell covered calls on buy and hold long equity positions. Buy and hold, again, just meaning you're holding this thing for a long period of time. You never want to sell the stock, or at least not right now. So selling a covered call could be a way to benefit versus selling the covered call in a green environment. Let me just touch on that real quick. If we're in a green environment, the market's likely going up, right? And what you're going to also experience, just to drill down on this, is that it's going to be extremely difficult for the market to make any upward progress unless we are in a green signal environment, okay? I just really want you to understand that. So if the market's going up, guess what? The signal is going to be green, guys. I mean, it's just the way it is, okay? Because I reverse engineered the market to build this model for myself, and now I'm making this data, of course, available to you guys through the subscription, okay? So the idea of selling the covered call in a yellow environment versus the green environment is that if you're selling a covered call in a green environment, you don't really want to get called out of this stock, right? You sell the covered call, and again, I'm not going to spend a ton of time on calls, but just to kind of cover this real quick. And again, if you don't understand covered calls, you're interested in, go out and do some some research on your own and learn about this stuff. But if you sell a call in a covered call in a green environment on a stock or whatever, you may get called out. You may get that stock or whatever taken away from you. So you're selling your upside. If you're selling a call during a green environment versus in a yellow or red environment, you're less likely. It could still happen, but you're less likely to get called out, okay? But also, and I've had to do this hundreds of times, okay, because I've been trading options for over 25 years. So if you sell a call on something and the stock continues to rise, in this example of doing it on a stock, you may have to buy that call back at a higher price than what you sold it for. Again, these are advanced strategies. If you don't understand it, that's fine. But if you are an options trader, just be prepared. If you sell a call for $5, you may have to go back and buy it back for 6 or 7 if the stock in this example continues to run up and you think you might get called out. That's just the price you have to pay. That doesn't happen very often, or at least I haven't found that to be the case with what I do. But just understand, you may have to buy that call back. Okay, so let's move on here. Second bullet point here. You may want to buy puts. Again, another strategy on the yellow signal. You may want to buy puts on your buy and hold long equity positions, okay? So this is a way, a put, of course, you're going to benefit if the underlying drops in price. So you buy a put, maybe a slightly out of the money or whatever. You have to figure that out. Put on your equity positions that you own. So you think, oh man, the market or the stock is going to fall. I don't want to lose money here. So you may want to buy a put on your buy and hold type equity positions that you don't want to sell or trim back in a yellow environment. That's another way to protect yourself. And again, guys, you have to employ these strategies where they're applicable. For instance, you can't buy puts. At least I haven't been able to find any broker that will allow you to do this. You cannot buy puts in an IRA or a 401k or a 403b or whatever. You can't sell covered calls in a 401k or 403b. At least I haven't found anybody that allows you to do that, right? So you can do covered calls in an IRA, but you can't buy puts in an IRA. So you have to match these strategies with the appropriate account that you're trading in, whether it's your 401k, 403b, IRA, SEP, Simple, whatever it may be, your brokerage account. So, check with your broker. If you trade with, Schwab or Fidelity or whatever, each firm will have their own criteria. Each account, whether at the federal level or whatever, will have its criteria that it will, as to what type of strategies it will allow in the account. So if I say buy puts on on your stocks or whatever in an IRA, and you go in there and say, well, you can't do it. Well, it doesn't mean I'm wrong, right? Just understand that. It's just mean you can't do that in an IRA. That's not something I can control. That's at a federal level, okay? So again, you have to match these strategies with the proper account. So if you've ever done this, and this is a fantastic way to really protect a long equity position at a very low cost, or sometimes even a break even, you can create a collar. A collar is where you simultaneously sell a call and buy a put on your long equity position, okay? And again, if you've never done this, if you trade options, you may want to go out and educate yourself on this, because there's a well-known multi-billionaire that did this back in the crash about 20 years ago, and he was able to maintain his wealth because his brokers were quite savvy, and he didn't get wiped out in the tech wreck back in 2000s, early 2000s, because his brokers took the stock that he had and put a collar around it, and that's why this guy is still a multi-billionaire. So creating a collar is a great way to protect your underlying positions. And again, a collar is where you sell a call and buy a put, and so you've collared that position. So again, this is another way to use the yellow signals. Also, in a yellow signal, you can buy a standalone put, right? You don't have to own the underlying to buy a put. So you can just say, well, I think this thing's going to go down. I want to try to profit from the stock or the market or the sector or whatever going down. You can just outright buy a put, again, depending on the type of account you're trading in. So that's another way to use the yellow signal. And also, and I had one of my subscribers did extremely well here recently by going long volatility during the early part of a yellow and then red signal. And we'll talk further about this in the red, but going long volatility, in other words, buying a call on the VIX or using an ETF to get exposure to volatility. So as the market goes down, generally you're going to see volatility go up. So again, just another way to use the yellow signal is to go long volatility during the early part of a yellow signal. Again, guys, these are more advanced strategies, right? Using options, using ETFs, using triple levered ETFs on, to go long volatility during these signals. These are more advanced strategies. So again, with any of these strategies, if you're not used to doing them, if you don't trade options or you don't mess with the VIX, don't do it. Okay, these are just ideas to show you how versatile and beneficial these signals can be for your trading and investing. With the yellow signal, this is a possible transition from green to red. So if the signal's been green for a while, the normal course of events would be as the market starts to roll over, the signal would turn yellow, and if the sell-off is severe enough, then the signal would go red. However, there's a lot of times where a yellow signal is nothing more than a pause that refreshes. Okay, the market takes a break, could be for a few days or a few weeks, and then it goes from green to yellow to green. So just because a signal has gone from green to yellow doesn't mean it has to go red. Oftentimes it does, but there are times where it goes green, yellow, green. Okay, and in that case, the market was just taking a break, catching its breath, so to speak. The yellow signal in that instance, where it goes green, yellow, green, the yellow signal was just nothing more than a pause that refreshed the market, and then the market can continue to advance in a green signal mode. In a more severe sell-off, we would see the signal go from green to yellow to red. And then going back up, the signal can go, and oftentimes does go, from red to green and bypasses a yellow signal. So if the signal has been red, it does not have to go back through the yellow zone to get into the green. The signal can go red, green, okay? Just the way the model works. Now let's talk about the yellow signal for financial advisors. Again, just like with the green signal, a financial advisor can use any yellow signal strategy listed when and if applicable, depending on your circumstances, your client, your own personal investing and trading philosophy and skill sets, and what you do for your clients, and also what your brokerage firm allows, okay? And as a financial advisor, you can use any yellow signal for timely client conversations, and you can use any signal change for timely client contact and conversation. So again, the signal goes from green to yellow. Great time to pick up the phone, start calling your clients and saying, hey, looks like we're hitting a little soft patch in the markets. Want to see if you have any questions. Do you want to rebalance your portfolio? Would you like to trim some profits, take some profits we just made while the market was going up for the last 6, 8, 10 weeks, whatever it may be. So again, these signal changes can really help out you financial advisors, because it gives you very, very timely data to work with and have really timely client contacts and conversations. And as a financial advisor, you can use any signal change to make timely compliance mandated adjustments or trades in a client portfolio. Again, if you're a financial advisor, you're going to know exactly what I'm talking about. So simple market signals and these signal changes help you meet minimum trade requirements where applicable, whether it's at a federal level or with your own brokerage firm. The simple market signals can help you meet these minimum trade requirements where applicable in a very timely, tactical way. Now let's talk about the red signal. The red signal is the worst risk versus potential reward signal. The red signal has the highest market risk associated with it and the highest market volatility associated with it of all signals. And the red signal is the most dangerous signal for equity exposure. During a red signal, we are generally going to experience negative market action, and the largest losses in bear markets happen in red signal environments. So please remember that the largest losses, including bear markets, are going to happen in red signal environments. We know that most stocks follow the general direction of the overall stock market. So if the signal is red, that means the majority of stocks in the stock market are probably going to be going down along with the overall market. Not every stock, perhaps, but most stocks. All right. In a red signal environment, you may want to further reduce your equity exposure during a red signal, and you may want to have your lowest personal equity exposure desired during a red signal. So whatever that looks like for you, okay? If in a red signal you don't want any equity exposure and you want to be 100% in cash and bonds, that's entirely up to you. Maybe you have a threshold of 20 to 30% equity exposure during a red period. Those are all personal decisions you have to make, okay? But you may want to have your lowest personal equity exposure desired during a red signal. And of course, during a red signal, you may want to increase cash or high quality bonds, depending again on how you want to de-risk your personal situation, if indeed you want to de-risk during a red signal. And you may want to go to a more conservative portfolio construction. So again, if you're an asset allocator and we looked at in a green signal, maybe you're a 70-30 type person. And then as an example, in a yellow signal, maybe you go to a 50-50 portfolio, and then maybe you have a 30-70 portfolio for the red signals. These are, again, just ideas. You will have to figure this out on your own as to your own personal, risk tolerance, time horizon, all that, how you want to employ this. But during a red signal, you may want to go to an even more conservative portfolio than what you had during a yellow signal. And during a red signal, of course, you may want to rebalance your portfolio and capture gains made during a green signal period. So even if you rebalanced during the yellow signal, you may want to rebalance again, depending on your own personal situation. And keep in mind, when you're rebalancing, if you're in a taxable account, you will have to keep that in mind, because there could be some tax consequences when you're rebalancing. If you're not in an IRA, 403b, 401k, whatever it is, if it's a taxable account, keep in mind that rebalancing could trigger some tax consequences. So always keep that in mind as well. Every single one of these are ideas and strategies that you yourself will have to employ at your own discretion, and you're going to have to use them in the proper account and during the proper time for you. Also keeping in mind any tax consequences that may be applicable if you're trading and working in a taxable account. During a red signal, another opportunity to sell covered calls on your long equity position. So we talked about this in the yellow signal, but during a red signal, this could also be a time if you have some buy and hold, some long equity positions that you don't want to sell. If you want to hold on to these positions, again, whether it's the overall market, a sector, a stock, this would be another opportunity to sell a covered call and perhaps bring in a little revenue to help offset any downside that you may have by owning that equity position, that underlying equity position when the market is falling. Also, you can buy puts on your buy and hold long equity positions during a red signal. Again, another way, and really a better way than selling covered calls, right? Buying puts really helps to put a floor, if you will, beneath your losses so you can minimize your downside when the market is falling in a red market environment, and you've got that put underneath your long equity position, which helps minimize the amount that you can lose during that time frame. And just like in a yellow signal, you may want to create a collar. A collar, again, is where you sell a call and buy a put simultaneously, and you can do that on your long equity positions to help minimize your losses. And by selling the call, you can use those proceeds to help buy the put. And so you can put that collar on at a very low or even zero cost in some cases. So again, that's a strategy that if you haven't done it, if you are an options trader, you're going to want to educate yourself on that because it's very effective. I've done it numerous times and it does work. It works quite well. A red signal environment would be an environment where creating a collar could make a lot of sense. But again, if you're not an options trader and if you don't work with options, don't worry about it. It's no big deal, okay? If you are an options trader, you could also buy standalone puts. You don't have to own the underlying position. So if you think the market's going to fall, you think a sector is going to fall, you think a stock's going to fall, this would be an opportunity to just buy an outright put without having to own the underlying position. And in a red signal environment, you may also want to go long volatility during the early part of a red signal. Keep in mind that the market will bottom and start to rise while the signal is still red. So that's why I say if you're going to go long volatility, keep in mind that the spike in the VIX is usually pretty short-lived, generally, a few days or a few weeks. So if you are going to go long volatility, long the VIX, whether it's buying calls on the VIX or using something like the VXX, if you are going to go long volatility when the market is starting to fall, I would limit that activity towards the beginning of a downturn. That's where that strategy will probably work best. But again, that's always going to be up to you. And also in a red signal environment, fantastic environment to dollar cost average new retirement plan money. Again, DCA just means dollar cost average, and new retirement plan, RP, retirement plan money. So dollar cost averaging new retirement plan money into a red signal is a fantastic time to dollar cost average into your retirement plan. And you may even want to increase your contributions to your 401k or 403b, SEP Simple, whatever it may be, retirement plan at work. You may want to increase your retirement plan contributions, your DCA, your new money contributions in a yellow or red signal to further take advantage of the volatility. Okay, so dollar cost averaging, again, works best when there's volatility. So the more volatility, the better that's going to work. And again, this is where you can do something that's kind of counterintuitive to most people, and you can increase your contributions during the red signal to take advantage of the opportunity to buy in at a lower price and dollar cost average into that volatility. So just another way to use the red signal. In a red signal, the following investors may want to make the bulk of their new money purchases during red signals when price to earnings ratios and valuations are compressed. So if you're a contrarian investor, a value investor, or a long-term buy and hold investor, you may want to use the red signal as an opportunity to make most of your new money purchases during those environments when PE ratios and valuations are compressed. Again, you're taking on a lot more risk in the short term, but if you are a contrarian or a value or a long-term buy and hold investor, this would be another way to employ the red signal. Now let's talk about the red signal for financial advisors. Again, just like with the other signals, for you financial advisors, you can use any red signal strategy listed when and if applicable, again, depending on the type of clientele you're working with, depending on your brokerage firm and what they will allow you to do, and of course your own investment philosophy and style. You can, of course, use the red signal for timely client conversations. So when the signal turns red, it's an awesome opportunity to reach out, have a conversation with your clients, talk about the fact that you're starting to see a little weakness in the markets, see if they have any questions, concerns, and you can make any necessary adjustments in their portfolios. You can use signal changes as a financial advisor for timely client contact and conversation. So whether it's clients or prospects, when the signal turns red, people are probably going to be scared. They're probably losing some money. And this is a great time for you to reach out and talk to people in a very timely manner, have the conversations, figure out if there's anything you need to do in their portfolio. And you can, of course, use signal changes to make timely compliance, mandated adjustments, or trades in client portfolios. And again, if you're a financial advisor, you're going to know exactly what I'm talking about there. So again, just to really stress this point, for you financial advisors, simple market signals helps you meet minimum trade requirements where applicable in a timely, tactical way. So the signals, regardless of which signal it is, can really help you financial advisors hit those minimum trade requirements and keep on top of your client base in a very timely, tactical way. The employment and outcome of any idea or strategy listed in this presentation is always 100% your responsibility. We make no claims as to the efficacy of any strategy listed in this presentation. Things to remember. The signals denote risk levels as determined by our proprietary model. Our proprietary model is driven by stock market data. There's no economic data in there. There's no lagging data. There's no opinions. There's no politics. It's market-driven data that drives the proprietary model. There's no way to know how long any signal will last. Some of the signals last a few days. Some of the signals last weeks or months. Be quick to pivot when signals change. Signals cannot and will not pick market tops or bottoms. Okay, the signals are about the amount of market risk you are assuming at any point in time. Now let's talk about the early bird indicator. The early bird indicator is our trend indicator, and it works side by side with simple market signals, weekly signals. The early bird indicator is a weekly positive negative signal indicating the current direction of the trend in the U.S. stock market. And I worked on the early bird indicator for 7 years to figure out the right time frame for this thing for my own benefit. I wanted something that stayed positive during the bulk of most uptrends, but yet was negative during the bulk of most downtrends. And I finally figured it out. And now we have the early bird indicator, trend indicator, which again is going to stay positive during the bulk of most uptrends and then negative during the bulk of most downtrends. So now you have two powerful indicators as part of the Simple Market Signals model and as part of your subscription to Simple Market Signals. You have the Simple Market Signals risk indicator, the green, yellow, red signals, and you have the early bird indicator, which is the trend indicator, positive, negative, showing you the direction of the trend. Now let's talk about the successful investor checklist. And every successful investor and trader I studied approached the market this way. They first wanted to know the overall stock market environment. Were they dealing with a tailwind or were they fighting a headwind? And again, that's where simple market signals comes in, right? It's at the market level. So get the market right first. And then if you invest or trade in sectors, then you move on to the sector, and then you move on to the individual stock if you are a stock investor. And then if you trade or invest in options, then you move on to options. So start at the stock market level. Figure out what's going on in the stock market, then move to the sector, then move to the individual stock, then move to the option. But again, if your whole style of investing is just investing in the overall market, there's nothing wrong with that. But you still have to understand what's going on at the market level. But if you are a sector, a stock, or an option investor, you still want to start with the stock market first. Let's review the proprietary signals. The green signal is the lowest risk signal. The green signal has the best risk-reward ratio for equity investors. The yellow signal means that there's moderate or increasing risk in the stock market. And during a yellow signal, what we can expect is that the market is probably going to go sideways to slightly down, and the yellow signal oftentimes is a transition period from green to red. Not always. It can go green, yellow, green, but there are times, of course, where the yellow signal is that transition period where we're going from a bullish to a very bearish environment in the stock market. The red signal has the highest risk associated with it. The red signal is the worst risk-reward ratio signal for equity investors. So in a red signal environment, be very careful. Again, we know that the worst sell-offs, including bear markets, happen in a red signal environment. And then our trend indicator is called the early bird indicator, and this is a positive negative indicator. So with your Simple Market Signals subscription, you have the risk indicators, green, yellow, red, and then you have the trend indicator, which is either positive or negative, which lets you know whether you have a positive or negative trend in the overall stock market. Now let's talk about a few points to remember. We do not invest in the economy. We invest in publicly traded companies. And regardless of domicile, company revenues can be global. So if you're studying the economy of one country and your mega cap multinational stock gets 50, 60, 70% of its sales outside of the country of domicile, what good is it going to do you to study the economics of that underlying country when the sales and revenue of your stock or your sector or even the entire market, half or more of the sales, revenue, and earnings from that investment come from outside of that economy that you're studying? So again, this is why we use market-driven data with the Simple Market Signals model. Okay, we don't use lagging economic data. We don't use irrelevant data. The Simple Market Signals model is driven by market-driven data. Now let's summarize a few key points here. Simple Market Signals measures and reports levels of market risk. Our weekly emailed newsletter is all text, no fluff. The risk signals are on the market as well as sector level. So as a subscriber, you're going to get the risk signal for the overall market as well as the underlying sectors. Our early bird indicator is our trend direction signal, again, a positive, negative signal. And if there is a signal change, a major signal change in the middle of the week, we're not going to wait until the weekend to send you that information. We will send out a special midweek update email when warranted to let you know of the signal change during the middle of the week. Most weeks you're not going to get that, but we have had weeks where there's been 3 special midweek updates. So we will stay on top of that for you. And again, we're not going to wait until the weekend to give you important updates. Simple Market Signals is about top-down thinking, and it's about being on the right or the correct side of the market. Okay, so get the market right first and then drill down if you're a sector investor, a stock investor, options, whatever, but start at the market level first. And again, that's where Simple Market Signals comes in. So Simple Market Signals is about top-down thinking, and it's about being on the right or correct side of the market. Simple Market Signals is about risk versus potential for reward. There are times that the risk that an equity investor has to assume is just too high for the potential reward. So you need to pick and choose your battles. And again, this is where Simple Market Signals can help you. Simple Market Signals is about risk versus the potential for reward. And remember, you are in total control of the implementation and personal outcome of all signals. And if you're not yet a subscriber to Simple Market Signals, check out the following information. Please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, this is just due to international compliance regulations. The Simple Market Signals product is a weekly newsletter that contains our proprietary market signals. The newsletter is emailed to our subscribers each weekend. Our goal is to have the newsletter to our subscribers by no later than 2 p.m. Eastern Standard Time each Saturday. You will also, as a subscriber, receive special midweek updates when warranted. So that is whenever there's a major signal or direction change, and that will make more sense after you go through at least one or two of the videos that we're going to introduce here in just a second. And guys, keep in mind that Simple Market Signals, this is not for day traders. So if somebody has a really short-term time horizon, Simple Market Signals probably is not going to be for you. Simple Market Signals is for investors and traders with at least a 6 to 8 week plus focus. So as long as an investor or trader has a time horizon of at least 6 to 8 plus weeks that they're focusing on, then Simple Market Signals is going to work extremely well for them. A subscription to Simple Market Signals is just $19.95 per month. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. So we give you the first 2 weeks so you can take a look at the newsletter, see what we do. If you don't like it, you have plenty of time to cancel without being assessed any fees at all. So we have made this as risk-free for you as possible. If you would like to learn more about Simple Market Signals, I have the following videos on my YouTube channel. I will also leave a link to these videos in the description box below this video. First off is the longest video. It's about an hour long, and it's the Successful Investor webinar. It's the entire story of Simple Market Signals, including my background and why I feel that most people are going to need Simple Market Signals going forward. There's a tremendous amount of market education in this webinar. So I would encourage all of you to go out and watch this because it is extremely educational, and if nothing else, it'll be very thought-provoking when you watch this webinar. So I would encourage you to do that. Again, that video is out on my YouTube channel. I will also leave a link to this video and all of the videos I'm going to introduce here over the next couple of minutes in the description box below this video. Now, if you want something a little shorter, about half an hour long, introducing Simple Market Signals, it has a lot of the same information as the webinar, if you will, but I cut it down to make it fit into a smaller time frame. So it still gives you a ton of information. It's just not as inclusive. So if you're not interested in investing the whole hour, which I would encourage you to do so, but if you want something a little shorter but still very informative, introducing Simple Market Signals would be the video you would want to watch there. And if you want the cliff notes, right, you want something that's less than 10 minutes long and gives you more information about the signals and the newsletter, which of course is how I deliver the signals. My proprietary signals within the Simple Market Signals model are delivered in the weekly newsletter. The newsletter has a ton of really valuable information in it every weekend over and above the proprietary market signals. But if you just want to kind of focus on the signals and the newsletter and what's in the newsletter, you'll want to watch the Signals and Newsletter Quick View, as I call it. And then if you want more information about the process, about what it looks like, when you subscribe, when you go out to the Simple Market Signals website, what does that look like? And it walks you through the subscription process and then what you can expect from there. This video will help you with that. And if you want some testing and you want to see some charts, right, in a video format of how Simple Market Signals would have worked in the 2000 through 03 bear market, keep in mind I worked on the model for over 20 years and it finally came together for me in 2017. So this is back testing, but it's very accurate because I was able to just go back, look at the charts, and figure out with the model where the signals would have kicked in and where the signals would have changed. So if you want to see the back testing I did on the bear market from 2000 through 03 and how Simple Market Signals would have helped you, the video here, S&P 500, 2000 through '03 using simple market signals is the video you will want to watch. And then I did the same thing for the 2007 through '09 bear market. So again, there's a video on that. I started using the model in 2017, and of course 2018 was a pretty tough year in the markets. The markets were negative that year, and if you'd like to see how simple market signals could have helped you in 2018, I've made a video on that as well. Again, all of these videos are out on my YouTube channel as well as linked in the description box below this video. And if you'd like to know more about my background, I have a video titled My Financial Services Background. It's about 3 minutes long, so pretty quick video, but it will give you my backstory. And I would encourage all of you to watch that video as well. And of course, if you'd like to go out to the website can be found at https://simplemarketsignals.com. And that is the website you will need to go out and subscribe to Simple Market Signals and receive our weekly newsletter, which will include, of course, our proprietary market signals.